Good morning, folks, and welcome back to Almus Market Mornings. If equities are the gazelles moving through the forest, jumping and skipping through quite quickly, bond markets are the elephants moving slowly but have an impact by the way they move. That's exactly what's been happening, and yesterday's market action saw a lot of limelight on the bond yields. Now, we have been discussing how, due to West Asia conflict, there's a rise in prices across countries. We are seeing the impact in recent inflation prints and how that influences the bond yields higher. In yesterday's trading, there was a further sharp sell-off in bonds, which have put the yields to some records. For example, 30-year US Treasury yield is almost at 5.20%, which is the highest level since 2007. 10-year has moved up to almost 4.7%. And this is a trend, not just in US, but across the world. Good morning, JK. So, in your experience, what happens to markets in such high yield regimes? Like we are seeing precious metals take a tumble, but do you see some other events coming through?
Good morning, Swaraj. Yeah, I think this yield is now from oil and war. It has shifted to the yields now, and they all focus on where the yields trade right now. Of course, it is also the result of oil and war itself. 30-year trading at 5.19%. That is the highest since the global financial crisis of 2008. And that is a huge implication because you see, in 2008, the US government debt was just 10 trillion, and now it has gone to almost 40 trillion. And you can see every percentage increase in the interest cost adds more than 1 trillion to the huge government debt that US is carrying. So that means, either they have to do something very drastic to control the yield, something like a yield curve control, or if they allow it to rise, then the Fed will have to follow it up with a short-term interest rate hike, and that can lead to economy slowing down also because the borrowing costs rise for everybody. Definitely, dollar will take a further rise because yields attract more money, higher yields attract more money from other regions. EM currencies will be weaker, particularly those which are running deficits, current account deficits, and who are dependent on capital flows like India. They will have the pressure. Commodities, which have already taken a tumble, and they can go further down because higher yields again make holding commodities unattractive for the investors as well. And finally, the continued rise in the yields can also lead to some sort of sovereign credit risks being priced in the CDS prices as well. So there are a lot of implications if this continues, and I'm sure policymakers are well aware of these things, but at least so far they have not given any indication that any coordinated action. In fact, the Japanese official yesterday, who is part of the G7 meeting currently going on, also said that no coordinated action was planned by them. Of course, actions speak louder than words, so I don't take his words at face value because no action is also going to be very risky for the economies. Now, speaking of Japan, Japanese government also wants an additional budget allocation, and that coming at this point of time is, again, going to push the yields further higher and increase the challenges. The tick data, where the inflows and outflows from US treasuries showed that there is a downtick in the inflows into the US treasuries from 9.49 trillion in February to 9.35 trillion. And sellers were, of course, Japan as well as China. Who sold the US treasuries, and their holdings have been coming down as well. So there's a lot of tensions in the market. And what I'm needing, you refer to the stock market. The stock market so far have really not had a meaningful correction. US stocks are still trading a lot closer to their all-time highs. And many other markets, South Korea, Japan, India, Taiwan, are also trading at the highs, multiple, like almost double from where they were a year ago. So I think these are vulnerable now as yields continue to rise and no action is taken. Now, as I said, completely related to war, what is happening in the war side is, President said that while Iran is wanting to make a deal, an attack could happen in the coming days if there is no deal is reached, and that is not something for comforting. But at the same time, Vice President Vance said a lot of progress has been made in Iran talks. So keep the market in blind. No clarity as to what is exactly happening. So in fact, if you look at the oil also, it's kind of in a range now. It's not making big progress on the upside, but it's not correcting down as well. One positive news, or I would say development that is evolving, is that the NATO is discussing the possibility of helping ships pass through the Strait of Hormuz if the waterway isn't opened by July. So they are probably going to give protection to the ships wanting to sail through the Strait of Hormuz. So yes, this is something going forward. If the war doesn't stop and Iran does not open the strait, this is something that can happen. Yes, there's no immediate relief at all. But definitely, in their own interest, the authorities will have to do something. Now, whether they can do only something in the market and get success in bringing down the yields, I doubt very much. Because if they do that and the war continues and the oil price continues to rise, any impact will be very minimal and also short-lived. Therefore, every action will have to be weighed in the background of what is happening on the war. If there is a positive development on the war front, along with that, if they take action, and that will have a significant impact, of correcting the yields as well as the overall tensions in the markets, as well as to bring down the dollar value, again, particularly against the EM currencies. Many currency, Indian rupee has been hitting new highs almost every day now. Actually, for the last 6 days, it has been hitting new highs. Now, Korea is also pushing towards its new all-time high as well. So, market is keenly waiting for some relief in the yields, particularly. As far as India is concerned, as I said, we hit a new low yesterday on the rupee, 96.6150, and 6 days in a row. We had, if you remember, we had a couple of weeks back, we had a correction to 94.05 when there was a reported peace negotiation progressing between US and Iran. But since then, rupee has weakened by 2.7%. And since the war began, it has weakened by more than 6%. And in the calendar year, by 7.5%. These are very large moves, and the rupee has continued to get undervalued. Now, probably my estimate is, I think we are almost 10% undervalued in the rupee versus its major trading partners. So the weakness is happening even with normal demand. Supplies have dried up. That's the main point. And RBI is the only supplier, and their intermittent supply, perhaps with some cash invert, is meeting the demand, but that is not sufficient to keep the dollar from going. And as we see, most of the buying is also happening from the PSU banks themselves, who have to buy for oil and other commitments, and their own customers also. So, is there going to be a free fall in the rupee? I mean, I wouldn't call it a free fall, but further fall is quite in sight. A lot of talk about hitting a century. No, in this strong trend, nothing can be ruled out. But at the same time, we have to keep an eye on what the authorities do in the global as well as in the domestic. As I said, just like the global authorities would wait for war situation to improve before they take some measures, even Indian authorities would wait to take some strong measures. I'm sure they're contemplating. And they would wait for some situation globally to improve before they take any strong measures to contain the rupee's fall. And further fall in the rupee is not going to help matters, because it is going to increase the inflation, and we are probably going to see a hawkish and RBI when they meet next month. So still a lot of worries around in every market. So I think world is hoping for some positive development on the war to trigger reversal. Thank you.
Thank you, JK. And yes, the spillovers of the war we are seeing in the bond markets, yields across, whether it's in US, Europe, UK, Japan, Australia, India, everybody, everywhere, the yields are going higher as inflation becomes a point of concern. We, of course, have been discussing this for the past few months in the podcast, how the impact of yields can sort of take shape. Broadly speaking, yesterday we have seen precious metals and commodities not do so well in the high yield environment, and there could be more to come if this sort of sustains. When it comes to rupee, we are hitting new lows against dollar. Now it's, I think, the sixth day in a row, as JK mentioned. We have weakened 6% since the war started. As of now, there is no respite. And Till the time there's no respite, we may have like sort of inching depreciation that's currently in place continue. That's it from us today. Thank you for listening. We will catch up tomorrow with a fresh round of updates.